mode.
Well, good evening, active traders. Welcome to Trading Volatility with my longtime colleague, Dr. Barry Burns, and myself, Ken Calhoun. Barry, it's great to share the stage with you again.
Thank you, Ken. It's always a pleasure. We seem to do this annually, and we've been doing it for, yes, quite a few years now, and it's always a pleasure. I love working with you, and I always pick up a thing or two, and I listen to your presentations as well. We're never too old to keep learning, and you're one of the best. So I'm privileged to be here, and I thank you for inviting me.
Well, sure thing, yeah. Look, I was, for all of you watching, and we've got just under 600 people registered, so a big epic turnout tonight. Thanks to all of you for being here. I was telling Barry how much I like his YouTube videos because they're very sharp and very intelligent, so highly recommend those. Barry will be doing the first 30 minutes, and then I will be doing the last 30 minutes. As always, all information is for educational use only. We're not making advice about what to buy, sell, or hold. By watching this, you agree not to make actual trades. Barry Burns from www.topdogtrading.com. Barry's given seminars around the country. He's widely published. I've got a lot of respect for Barry because he knows his stuff. His technicals are impeccable, a very sharp guy. He's author of Trend Trading for Dummies, published by Wiley Publishing. He's received Reader's Choice Awards numerous times from technical analysis and stocks and commodities readers for trading courses and websites. He's founded the Top Dog Trading site to help students shorten their learning curves and becoming more successful. And he's one of the good guys. I heartily endorse Barry Burns. He's one of the smart guys to learn from. So with that, let me go ahead and turn it over to you, Barry, and I look forward to seeing your presentation.
All right. Well, thank you. I look forward to seeing it too, because I've never done this one before. All righty, let me get my screen up here. There we go. So you just saved me some time. I was able to actually just skip through the first 3 slides there. So thank you for that nice introduction, the legal disclaimer, and now our lawyers are smiling. Well, no, my lawyer never smiles. But anyway, he is satisfied. So that's the important thing. So yeah, welcome everybody. I'm thrilled to be here, and we're talking about volatility today. So this is a brand new presentation that I've never given before. So even some of you here today know me and are my students already. So you too will pick up some new things. And Ken and I have complementary approaches. Like most traders, you know, there's more than one way to, well, we'll be politically correct here. There's more than one way to groom a cat. I've got a cat, so I got to say it that way. And yeah, I've got so many friends in the trading world. I've been trading for 50 years, believe it or not. My dad was a stock trader and started teaching me when I was 8 years old. So been around the block 50 times and done everything wrong you could possibly do. But then I've had many mentors over the years who graciously shared with me some tremendous insights that I'm able to employ now successfully. So what you're going to hear from me, some of it might be a little different than what you've heard before, and hopefully that's the case because, hey, if not, then you didn't learn anything new. So I'm here to hopefully share some things with you that'll enhance your trading and that you can start using right away. So first of all, when I think of volatility, the very first thing that comes to my mind is the concept of cycles. And I studied under one of the great cycles masters, and boy, he just dramatically changed my trading. That was many, 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 many years ago, back in the days of yore. And there's several different types of cycles. We're not going to talk about this too much, but just as a little introduction, cycles are a big part of my trading. So for example, there are seasonal or calendar cycles, and believe it or not, we're already starting into the holiday cycle. I know, it's August 2nd, but if you watch the news, financial news or whatever, they're already starting to talk about the holiday cycle, Christmas and so forth, the biggest retail part of the year. So different markets, different stocks, different sectors thrive during different times of the calendar year. That's one type of cycle. The most common type of cycle that most people think of, I believe, are the oscillations in the market, swing highs and swing lows. Very important. Here's a third one that very rarely, in fact, I don't think I've ever heard anyone talk about this before. And I don't talk about it too much. Maybe I'll create a presentation on this someday. And this is called the order chaos cycle. So you've probably heard of the book, or maybe even read it, Random Walk Down Wall Street. And they basically were saying that the markets are perfectly efficient, therefore you can't gain an edge. And basically, yeah, if that's true, then what are we doing, right? We can't make any money trading. Only problem with that is that there are people who have consistently made money trading for many, 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 many years. And the authors actually came back later, and I won't say they recanted their position, but they softened their position. And then there's other people who say that, oh no, the markets are perfectly orderly. And you'll get a lot of W.D. Gann adherents talking about how, oh, they predicted the market 10 years out into the future to the exact day and price, and basically they're the Nostradamus of stock prediction. Well, I studied both of those schools of thought, and both seem to have some merit. They both make some good points, and of course, can always cherry pick examples to prove anything. And what I came up with was that, oh, you know what, they both have truths. But what's really going on is that there's a cycle in the market I call the order chaos cycle. So sometimes, in fact, most of the time, I would argue, the market is in basically a chaotic cycle, wherein what I mean by that is you can't really establish a probability scenario that gives you an edge that favors you. So therefore, you should just be keeping your powder dry during those times. On the other hand, there are times when the market actually takes on an orderly fashion. This generally happens when institutions get involved. They start accumulating positions. Their methods of trading are very orderly and systematic and rule-based, and then that reflects, of course, in the markets. Well, that's when we want to trade. So we want to trade during the order cycle. Another type of cycle that is very commonly talked about is coupling and uncoupling cycles, and that's where various markets, sectors, industries will start moving together, and then that's the coupling, and then they'll diverge, and those create great trading opportunities as well. And the fifth one, and the one we're going to focus on today, is the volatility cycle. So when I think of trading volatility, my personal favorite way, and there's, again, different ways to trade this, different valid ways, but the one I'm going to show you today is trading the cycle of expansion and contraction. So the range of the market, how far it moves, how fast, how much price it covers in a certain period of time. So we are going to answer a couple of questions. The most common questions that come up is, okay, well, what patterns do I trade for volatility? Number two, how early or late do I get in? And that's a big one, right? That's a challenging one when it comes to volatility. Which direction do I trade? And because volatility in itself does not indicate direction. Trend indicates direction. Volatility, one of the most challenging patterns to trade, is an expanding triangle or megaphone pattern, as it's sometimes called, because it's really directionless. You get higher highs and lower lows, but it's still a high volatility situation. So it can be very tricky. And then, of course, where exactly do I enter and where exactly do I get out? And, well, that's kind of what trading is all about, right? Where do I get in and where do I get out? So some of the common patterns that are taught that you may be familiar with, just to bring this into your sphere of recognition, are number one, Bollinger Band squeezes. So that's a nice pattern, can be traded very well. Another one is contracting channels. Again, very legitimate pattern that can be traded very well. Wedges, and again, I actually like trading wedges a lot. And then triangles, which are a little different than wedges, although they're similar. And then moving average convergences. Now there's others as well, but these are just some and five. And we only have 20 minutes left for my part of the presentation. So I'm going to talk about the last two. I'm going to focus on those two. And then if I have a little extra time left over before my 30 minutes is done, then I'll have a bonus set up for you as well. All right, so today I'm going to talk about moving average convergences and triangles. Now, let me get my little drawing tool up here, or you know what, I think I'll just use the little spotlight. So moving average convergences. I don't see a lot of people talking about this one, and that's one of the reasons I chose to share it with you today. So I'm using these four moving averages, the 15 exponential, the 50 simple, the 100 simple, and the 200 simple. And here they are. Now these blue lines, these blue horizontal lines, as you can see here, these are simply marking major previous swing highs and lows. And it's based on a mathematical formula. And they automatically plot on my chart. So they provide support resistance into the future. But the thing that I'm interested in for this pattern is where these 4 moving averages all cluster together. So just to be clear, the black line, that's my 15 EMA. And then my 50 SMA, I have it color-coded so it will change from green to red, whether it's angling up or down. So that's that one. The 100 simple moving average is the orange, or maybe it looks yellow on your charts. And then the 200 simple moving average is the purple one. So you can see here they're kind of spread out. But here, they're all clustered together, right? Very, very close together. 15 is actually pretty much touching the 200, and the 100 is touching the 15 here, and they're just all bunched together. Now, what does that mean? Mathematically, what that literally means is over the last, and well, this happens to be a 3-minute bar chart, but whatever. You could use this on a daily chart, 60-minute chart, whatever. But over the last 15 bars, 50 bars, 100 bars, 200 bars, when all was said and done and we came into this time in the day, 9:30, the market had gone nowhere. Okay? Now, yeah, since 200 bars ago, it made a lot of moves. But after all was said and done, by this time of day, the market found a place of equilibrium where it just is going into a contraction. So it's a contraction of volatility. And so these are opportunities that I look for to then, as we talked about earlier, and this is why I wanted to bring up the issue of cycles first, I look for contraction, and then I look for expansion to follow that, because we want to have a good reward to risk ratio, right? One of the cardinal rules of trading, obviously, is to keep your losses small, let your winners run. So we want that to, that rule to apply to everything that we do. And one of the nice ways of doing that is to trade contraction patterns, because you can keep your stops very, very tight. So we look for this pattern, and that is basically the indication, if you will. Not that we're using indicators. Well, moving averages, I guess, are kind of indicators, but mathematically, we're seeing that, yeah, okay, so the market has found a place where it is contracting. Volatility has now died down, and that is often followed by a big surge in volatility. And we like that. We love that, because that usually provides us a big reward, and then again, a good reward to risk ratio. Right, so let's see what happens after that. And let's see, oh, my chart is not activated. There we go. All right, so here you see this is where we were looking, where we had all of our moving averages contracting together. And then price breaks out above it. And this is not unusual, by the way, for the market to break out above the moving averages. And you could even say it broke above that support there and just kind of held above there. In fact, let me draw a little line here. I'm going to have to get this line up here. Change the color. No, that's a good color. So if you look at this area here, and I'm horrible at drawing straight lines. Oh my gosh, I actually didn't do too bad. So it gets up here and then stays above. Then where do we go? Okay, finally it starts. Now sometimes these things will break out and just go straight to the moon. Other times they take a little while to gain traction. So it gets up here. Great. Volatility is starting to increase a bit. Where do we go? We go to our next horizontal line, which was a major swing high in the past. Come back down to the 15 EMA. Retest this again. Come all the way back down to retest the high of this contraction pattern. And that's called a throwback. And this is one of the, there's different ways you can trade this. Now, you could trade just the breakout itself if you want to. And that's fine, but sometimes they fail. Or you can wait for the throwback, and those are more conservative opportunities, and I love them. The problem is you don't always get the throwback. So if you decide, oh, I'm going to trade and wait for it to retrace back here from resistance becoming support, the one thing that you do sacrifice is, okay, you're not always going to catch every volatility breakout. And that's okay. You don't have to. You just choose the plan that fits your personality and you'll live with it. Then you say, that's fine. That's the choice. Everything has pluses and minuses. This is the game I'm choosing to play, and I'm okay with that. But you gotta be okay with that. So you cannot mourn, you cannot grieve if the market just takes off and it never does a throwback if you decide to do the throwback technique. You just say, oh, okay, didn't do it that time. I'll wait for the next setup. No problem. There will be another setup that'll work the way you want it to. Okay, so anyway, that is numero uno. Number one, eins, Korean hana, Japanese ichi. I'm pentilingual with the number one. That's pretty impressive. Okay, let's go to the second pattern. Now this one's really interesting. So you might look at that and say, oh, triangles, I know triangles. Okay, good. I'm glad you do. But I got a couple of new things here to show some of you. So triangle, this is a symmetrical triangle. Of course, you can have ascending, descending, symmetrical, a wedge. Well, this is lower, high, higher lows. We've got actually several higher lows here. And that again is a contraction pattern. So volatility is coming out of the market. That's the cycle of volatility that we're in, is a reduction of volatility. And then what are we waiting for? We're waiting for the next cycle of expansion to start, and that's the one we want to trade so that we get a nice, boom, impulse move, right? Okay, so there's a couple of cool things about this one. Now, what makes a high probability triangle? There's several things. First of all, I like trading, and this is a little aggressive. So as I said before, you can wait for various entry points. So here's our triangle. Some people will say, okay, trade the breakout of that lower trend line. And that's what they do. They just trade the breakout. And that's fine. That's cool. Again, you at least have the opportunity of when it breaks out, you're in. Now this one, you do get at the throwback. It does retrace back. So then you'd be golden if you waited for that. And you're okay. So those are the two traditional ways of trading, both perfectly valid. Here's what I like to do. I'm a little more aggressive, and I'm going to tell you right now that this is, for full disclosure and complete transparency, the way I trade it, being aggressive, it doesn't have quite as good a win-loss ratio. All right, but I found in trading that quite often the two major ratios in trading are your win-loss ratio and your risk-reward ratio. And it's really hard to get both, the best of both worlds. So it's often kind of a trade-off. You're either going to get one or the other. Now, my win-loss ratio is better than 50-50, but I could probably improve that even better if I didn't take as aggressive trades. But I make up for it with money management. So I actually trade what I call inside the triangle. So instead of waiting for the triangle to, or the price to break out of the triangle, I go short inside of it. I'd go short right there. I'd go short right there. So will you get more losses? Yes. Yes. But you're getting in earlier. So your reward, when it does work, your reward to risk ratio is better. You're buying at, or you're selling in this case, at wholesale. Down here, you're selling at retail. All right, you can kind of look at it that way. I'm not being literal, but obviously if I'm shorting here, I'm getting a better price than if I'm waiting down here and shorting over here. So this is a higher probability trade as far as win-loss ratio. This is better risk-reward ratio. The way that I kind of make up for that is I actually will take profits down here. So I'll take initial profits. So we've got this low, okay, and that I'm expecting there's going to be a breakout. Now, as I trade bar by bar, so as price is coming down to the lower trend line, I'm watching, and I might even get out there. I might even take some of my my shares off there. I'm just watching the price bar by bar, and you know we've got red bars. Notice they do slow down. They get more narrow range. So there's a little hesitation there. So probably other people are seeing the triangle too, but it does keep going. And I would actually lock in some profits right here. That's the 50-period simple moving average. It's also this low. And therefore, I'd say, okay, so I'm going to, this is my money management. This is my risk management in case it doesn't work, knowing that it's more of an aggressive trade. And then I'll wait. Now, when we get their throwback, I'm definitely going to stay in as long as everything continues in my direction, and I might even add back to the position. I might even throw some extra shares back on, saying now, great, we got the throwback, so I'll actually go ahead and add to the position going short. All right. So some people accuse me when I show them this. They say, well, you're not really trading the triangle, but you have to understand I am trading the triangle pattern. That is my intention, is trading the triangle pattern. And it's a little bit radical. Don't know too many people who do it that way. Now, here's another little tidbit. Here's what makes this particular one higher probability, is that I have a way of counting waves. I don't use Elliott wave, by the way. I call them Berry waves. Just kind of a joke. But anyway, it's a very mathematical formula that I use, and I don't recount waves. I don't impose a 5-wave structure on the market. It's higher highs and higher lows, just a little more to it than that, but that's basically what it is. So the average trend these days, I find, is 5 waves of the Berry waves. So what we do is we get a wave 3, we get a wave 5 that goes a little higher, and then we get a lower. Now, lower high. So what is that? That is a head and shoulders pattern. So this is why I would be more confident trading inside the triangle on this particular pattern, because it's two patterns in one, to quote some commercial. I forgot what it was, Trident gum or something, I don't know, some gum commercial. So we've got our head and shoulders pattern, and we've got a triangle pattern. And therefore I say, oh, I call that concurrent setups. So whenever I get concurrent setups, and I'm always looking for these, then to me, oh, now that is a higher probability trade, and I'm much more confident on taking that aggressive entry. Okay, here's another one, detachment from equilibrium. Alrighty, so this is how I look, another way that I look for equilibrium in the market. So this is the bonus one. So we talked about moving averages converging together, right? And again, that's a contraction pattern. We talked about triangles, and again, contraction pattern. Both of them, we're looking for expansion out of contraction. Expansion to follow contraction. Now, here is the third one. Fortunately, I have time for this. So again, this is not one that I see many people talk about. And I just created this at 2 a.m. this morning. So I like to use floor trader pivots when I'm day trading. And the pivot point, PP, or central pivot, I actually prefer to call it central pivot, but this is Ninja Trader, and the way they set it up, it's called pivot point. Same thing. Okay, so that's kind of a balanced position. So then overhead, you have resistance 1, underneath you have support 1, support 2, and so forth. So it's considered a kind of a balance of power, if you will, for the day, and it's based on the calculations from the previous day's high, lows, and close. So I look at that as a level of equilibrium. But then I also look at yesterday's close. That's what YC stands for, yesterday's close. So I'm looking at both of those as a zone. And sometimes they'll be real close together, and other days they'll actually be quite far apart. So here I've expanded the chart, same chart, and I've highlighted the zone. So as long as the market is in this zone between the central pivot or pivot point and yesterday's close, I consider that a very neutral position. The market has not created a strong sentiment to go long or to go short, to be bullish or to be bearish. And again, as often happens, the market will make little moves, and sometimes, yeah, it'll just haul butt and it'll just keep going, unidirectional. But more often I find that they kind of play games, and they'll go below it. That's why L is yesterday's low, another obviously very important area. But they'll game that level too. And of course, everybody's watching yesterday's high and yesterday's low. So they go below there, and then they come back to it, and they come back down above it or below it, and then they come all the way back into the neutral zone. Well, guess what? That's another type of, again, same concept. See how the same concept can apply to different patterns, the throwback. So we come back into that neutral zone, and now is when it finally releases and goes to the downside. Where does it go? It goes to the S2. These are the floor trader pivots, S2, support 2. Alrighty, and if you want to see what happened after that, you can see for the rest of the day, these, by the way, this down here are, I'm in California, I'm in Los Angeles, so these times are California times. So this is where the market actually closed. And so we opened here, we had a gap up, actually, it gapped up, came straight down, boom, came back into the neutral zone. And then that's where I say, okay, now let's look for this thing to take a not only a directional move, but we want to see this thing hopefully go into a cycle of high volatility to get a great reward to risk ratio. So you can see the rest of the day, you could have just shorted there and stayed short all day long. And it goes down, by the way, this level here is a cluster. And the cluster is the blue line is actually another major swing low from the past. And then I've got, you see it says S2, S3. That's a mid pivot. So not only do I like to use the traditional pivot levels, but I'll also put in mid pivots, which are 50% between the traditional pivots. I only use mid pivots if the previous day was wide range. If the previous day was narrow range, then your normal pivots are going to be pretty close together, and I don't apply the mid pivots. But these mid pivots work real good when the previous day's range was wide and you get a lot of distance or a lot of space between your traditional pivots. All right, so how are we doing on time? Actually, pretty good. All righty. So important factors are what patterns to trade. So I gave you 3 today real quick. This is like the Reader's Digest speed dating version. Now, which direction to trade is a really important one, right? That's one of the big questions people have in trading these breakouts of low volatility patterns, whatever they might be. One of the things that I use is I use momentum on the higher time interval to determine the direction I'm going to trade the breakout. Momentum is strength, right? The mathematical formula for momentum is literally velocity times mass. So when I was in Chicago, I was trained at the Chicago Mercantile Exchange, and I talk about energies because when I was down on the exchange floor, you felt the energy. It was very visceral. People yelling, screaming, lots of orders going in. That's velocity. Mass equates to volume in the market. So it's not only how many shares are going through, but also the size of the individual orders. So are the whales trading or are the retailers trading? You know, because there was a lot of guys who traded on the floor and they didn't make any money. You think, oh, they're floor traders, they make a lot of money. No, it's like Hollywood. They're trying to make a lot of money, but they're really bartenders. You know, they're just going there to chase their dream. And like most people in Hollywood here, you know, they never become a famous actor. Well, same in Chicago. Yeah, they'll try, but their night job is the one that's really supporting them. So anyway, it's important that you see the size of the individual orders, so you know if you're trading with the whales or just the retailers as well. So that's what momentum is, literally velocity times mass. I want to see that on the bigger time frame. Whichever direction that is going, that is most likely the direction the market's going to follow through, and that's the direction that I take these trades. Okay. Oh, and then, yeah, how early or late to get in, that's always a big question too. Don't have time to answer that, but I do have the answer for you that I will give you for free. So 1 minute left. I actually did pretty good here, surprisingly. So here's my email, barry@topdogtrading.com. I'm going to turn it over to Ken here in just a minute, but if you have any questions for me, I'm not going to answer questions right now. So if you have any questions for me and we don't get to it today or whatever, feel free to email me anytime you want, barry@topdogtrading.com. That'll come directly to me personally, and I love communicating with traders, so never feel shy about that. And I do have a free 5-day video course on professional trading that I'm happy to give you guys as a total gift today. No money down, no credit card required, no nothing, just go get it. And it's got 5 videos. Each one is about 20 minutes long. At the end of each video is an interactive quiz. And it's not just theory. I'm actually giving you one of my trade setups. It's called the Rubberband Trade. And that's on video number 4 of these 5 videos. And that's a trade that I still take all the time. Every time this thing sets up, I still trade it. So I'm giving you a really valuable trade setup. My hope, my intention, is that you can go and start, making money with that right away. And then, as I said, when it comes to the issue of timing, okay, when do we get in? That is challenging, but I have a cycle indicator that I've created that is a market timing indicator, and this thing is incredibly accurate. And I'm not saying that to sell you on it, because I'm actually going to give that to you for free as well. So I do webinars on this periodically. I think we got another one coming on Saturday. Yeah, Saturday's our next one. So if you want that indicator, I don't just email it out to people. It's actually nothing you download, by the way, just to be clear. This will work on any charting platform out there. What we do is we take an indicator that's already in your charts and modify it. But so I teach you how to do that, and then most of the presentation is showing you how to trade it, what patterns to trade on it, which cycle highs and lows you want to buy, and which ones you don't. So the tutorial is absolutely critical. And all that for free. And just go ahead and go to this webinar, or this, let's see here. Okay, anyway, maybe Ken can put that in the chat room there. And yeah, you see it's a bit.ly shortener there. That's the website. Just go there, fill out the little form, and you get all of this absolutely free as my gift to you today. So, whoo-wee, I went 1 minute over. So hopefully that's okay. Thank you, Ken, for having me here. And now I'm looking forward to hearing your presentation.
Hey, thanks so much, Dr. Barry Burns. Very intelligent presentation. I was taking notes. What I like about it was, I like best the first one that you covered about the contraction expansion of the moving averages. I think that'll really help traders learn how to visually look for when price is on the move and starting to do something other than consolidating, and that's where the trade setups occur. So really intelligent, so appreciate it. Really smart presentation as always.
Thank you.
All right, well, hey, welcome aboard, everybody. And to continue on, I'm Ken Calhoun. I run TradeMastery.com. Let me start off by asking a quick question. How many of you are day traders? How many of you are swing traders? Or how many of you do a little bit of both, like me? This is my favorite chart in the whole stock market right now. Lumber liquidators. We nailed it. Yesterday I called long 31.6 in my live, or 30.6 live room call yesterday, and today we got a breakout in it too. My presentation on volatility is going to be focused on 2 main components. One is the directional trend strength, the relative strength of the underlying trend. The other is trading ranges. Now, does everybody see the truth of the matter? Making money in this kind of chart potentially would be a lot easier than, say, trading, I don't know, let's pick a stupid $3 pop and drop stock. Trading cheap stocks is usually a fool's errand and not really a smart idea. It's a good idea to, and thanks for those of you who are posting. As a professional day trader since the 90s, I trade instruments like this because it's a lot easier to get a piece of the action on an open range breakout run for something that runs a point or so. For me, in volatility, it's all about directional consistency. And once I get into a trade, I could throw darts at it all day long and come out smelling like a rose. Those are the type of trades you want to set up for a day trader. A lot of you are swing traders too, so we're going to be looking at swing trading charts today. I'm all about ranges, trading ranges, and relative strength of the patterns, right? So we're going to be looking at strategies for how to capitalize on that using a variety of different charts in live markets. But first, a quick introduction for those of you who may have been hiding under a rock and haven't heard of me. I've been around since dinosaurs roamed the trading earth. I've been in Market Watch. I'm a UCLA grad. I did my master's thesis on Kaizen, on continuous improvement. I'm a former corporate statistician and quality engineer for the Ford Motor Company. So I've got a strong quantitative background, and I found it a lot easier to deal with charts than people. How many of you have ever had a boss who's a complete moron? Just give me a show of hands. Or coworkers are complete idiots. I found that I like trading because I can work with smart other educators like Barry. I self-select. I like to work with bright, smart, the sharp pencils in the bunch. And folks like you who are traders, who are trying to better your lives. And I do not have patience for Dilbert like cubicle lifestyle. So after being a internal quality management guy and then going into consulting for another 8 years, I found the stock markets in the late 90s, and I've been there ever since. So anyway, you may have seen me in every month's issue of Stocks and Commodities on Trading on Momentum, my column. You may have seen me in Market Watch. Anybody remember Daytech? That was like back in the 90s, right? 2001. I run Day Trading University, and now Trade Mastery is the new name of the site. Been all over the place. Anyway, let's start off with volatility scans. What's worth trading in the first place? Now, I will often trade cheap instruments. Don't get me wrong. For example, here's some real money trades from a few years ago, and you can see a lot of these guys are small caps. They're under $10 a share. To me, swing trading is all about a game of small edges. I am fine making $800 like I did in this rack of trades the hard way, trading small shares, 10, 20, 50, 30, 100, 200, up to 400 or 500 shares, and having it all add up with a stop along the way to keep me honest, right? So, and that was back 2009. So one thing I want to teach you from a volatility and a trade management standpoint is it's all about a series of small trades that add up. It's not about swinging for the fences. You should not be trading thousands of shares at once and blowing up your trading account and then having to hide that from your spouse. And you know who you are. Whenever I speak for Money Show, I always say, how many of you conceal your trading losses from your spouse or your family? If that's you, stop the madness. There's got to be a better way. And I want to teach you, at least what I've found in trading millions of dollars worth of stuff over the years, how that works. Swing trades, best to focus on instruments in the $20 to $70 share range. It's more hit and miss. You get a lot of volatility with cheap instruments under $20, but you don't get consistent trends. And so I like instruments with that price range. This is really important. This is a rider downer. Minimum 10% range on a 15-day chart. So what I mean by that is I have to look at charts. I'm a trader. 39 to 45. Is that 10% or more? For all the math whizzes out there, yeah. So for a $40-ish instrument, it should have 4 points of juice, 4 points high-low range or better. Or something like this one, SYY, 50 to 53. Does this have enough volatility? No, it doesn't. It fails that test. It has a nice trend, but the profit potential, the risk reward is not good. So the trend directional strength is good, but it fails my critically important, and I've traded over 4 million in a single year, as much as with proof of P&L, screen cap proof. I'm a real trader. You don't want to trade instruments with compressed ranges. Let me pick on AT&T because I've just picked on AT&T for 15 years. And of course, now that one looks okay. Well, let's pick on a big cap like Intel. When it comes to volatility as a trader, one of the things you want is directional strength. And you have to have ranges that are worth trading. So for example, Verizon has a range of 43 to just under 50. Okay, so that's a 7-point range, including its gap continuation. So it meets my 10% criteria. Bonus tip. Thou shalt not buy nines. In this month's issue of Stocks and Commodities magazine, I have an article. You can go get on the newsstand if there's any of those left right now. I think there's still Barnes & Noble. I miss Borders. Anyway, sell nines, don't buy nines. A good example of this is one of my favorite charts that I'd been calling in the 30s. I told all my traders to sell the 39 target, and it hit, which was Weight Watchers. From a volatility standpoint, this thing crushed it, right? Weight Watchers. This is what I call, in honor of one of my favorite 80s movies, Wayne's World. This is a Shwang chart. It's a nice technical term, Shwang. There's a little levity there, but this guy ran from 12 to 40. Traders will sell nines, so make sure that you always never, ever, ever, ever buy anything with a 9 in it, because that usually won't work out. This time it did. The 19 wouldn't have. If you'd bought 19, you would have got stopped out. The 29 would have worked out, the 39 would not. So 2 out of 3 times buying a 9 was a bad idea. That's a sell target. So from a volatility standpoint, I want you to start thinking about selling when something reaches a 9. And look, always seek charts that have nice, wide, consistent ranges. This was my favorite pick until 2 weeks ago when I said sell it because we reached a bearish engulfing here with a 9 right under the decade value. Just like whole number support and resistance is a very effective volatility criteria for cheaper instruments, when things get up in the $20, $30, $40, $50 share range, every $10, what I call the decade value, I've published on this for years, is another good reason to sell into that. So make sure that you're looking for those types of criteria points. The main point that I want to give you right now is 10% minimum is the rule of thumb. So this thing went from 29 to 33. So that barely meets and does pass our 10% rule. Okay, so those kind of charts make sense because they've got the volatility in the range it's worth taking a shot at. Let's take a look. Got plenty of charts to go with. So that's what I mean by 10% range. Volume should be at least 1 million shares a day. And we look at 15-day highs, cup breakouts, ascending triangles and wedges and bull flags and all the rest of it. Favorite chart pattern 101 stuff. What I like is what I call acceleration ramps, and that's where you got a steady uptrend followed by a sharper angle breakout. And we'll look at a couple examples of that in just a minute. For those of you who are day traders, this is something that I put together just last week, and so it's a world premiere here for the public. I put this together for my live room members. When it comes to figuring out what the heck's worth trading, you want liquidity and you want volume and volatility. The two V's are your friends. So you want this quadrant. You want things that have both high volume and high volatility. You need to avoid cheap, low volume, low pop and drop penny stocks that are treacherous and go up and go down. People claim to be making bajillions of dollars trading penny stocks, but magically 99.99% of the rest of the world doesn't. There's a reason for that. It's called odds. You want to trade things where you've got a clear edge. So I like instruments in this range with at least 15,000 shares a minute for day trades or higher volume. Stocks under $10 are going to blow up your trading account. I've taken the biggest stop losses in my professional career trading the cheapest instruments. Here's another good quick tidbit here. High volume but low volatility is also not a smart idea. The E-mini future day trading, usually a stupid idea because unless you're in a rally market, but much of the time, like a couple months ago for 3 months in a row, the market was sideways. Anything that's tied to the indices, like the E-mini futures or the spiders or diamonds or Qs, are going to be choppy on the open. Just like large cap stocks tend to be relatively compressed. So they have plenty of liquidity, which is good. It means your order fill and your slippage is minimal. But the trade-off is there's not enough volatility to make it worthwhile unless you absorb too much upfront risk by trading too many contracts or too many shares. So that doesn't make sense. And by the way, this is based on thousands of real money trades I've done. It's taken me nearly 20 years to figure this stuff out. And again, a corporate statistician, nationally certified quality engineer, Baldrige Award examiner. I've got a strong background in quality management, which I bring to the markets. And one of the things that I want you to get a clear handle on is the types of instruments worth trading and the types of patterns that make sense. So, finding volatile trades, strongest day in swing charts, risk management and scaling. Minor gap continuations are going to be the single best types of patterns for intraday and swing trades. Minor is operationally defined as less than 10% above the price. So a $30 stock that gaps to 31, we're good to go to buy new highs. A $30 stock that gaps to 35, 36, not so much. It may do a gap fill. So up, a point or so, up to 10% maximum. Multi-day high breakouts, and entries following wide candle days. From a volatility standpoint, that's something that I think will be a refreshingly good look. But first, a quick tip. Volatility is like margin. And by the way, you guys have no business trading margin unless you're winning, all right? You have no business trading live real money accounts unless you're profitable. You should not be trading live capital unless you can at least double a paper trading account, all right? Why waste money? Instead, invest in education and learning, or at least practice. Do a lot of paper trading. I wish somebody told me that back in the 90s before I blew up two trading accounts before I figured this out. Like Barry, we all had these experience of what not to do. This is a mean reversion breakout pattern, and usually not a very good one because the strength is great, the volatility is there, but it only ran up for a few minutes. Often, I used to call these 1, 2, 3 patterns, but I have an article on both mean reversion, meaning it reverts to the X bar mean for the corporate statisticians out there. It'll break out, it'll pull back to half, and then resume its initial trend. And I know Barry had a similar pattern too, snapback or whatever. And that's the same kind of thing. You see this kind of volatility. You'll see a breakout and move back to half and a move up. The best trades for intraday trading are usually going to be right above the previous day's high, which is why I use a 2-day 1-minute candlestick chart for my day trades. This type of chart is ideal because you've got a cup pattern high and also big picture. You could make the technical case for the fact that this is an ascending triangle as well, putting my technician hat on. So an ascending triangle, little minor move up here, a bullish cup or two, and then it took off to new highs. And I called this long for my traders today in the live room. I called it long yesterday too at 30.6. Anyway, this type of volatile chart pattern makes sense because it's clean. You could throw darts at it and usually come out doing well, and the volatility is there. For intraday trading, you want to have instruments, at least a 1.5, minimum 1 point, but preferably 1.5 up to 4 or 5 points of volatility. So that way, with a consistent trend, so it's not all over the map. What you do not want to day trade are cheap, low float, under $10 stocks. There's a lot of social media savvy knuckleheads out there who were in diapers when I started trading. These kids are, those pesky kids, putting on my Scooby-Doo, those pesky kids, they would have got away with it if it wasn't for whatever. The point is, you got a lot of these young kids out there who are college age or just slightly older, misleading the public, saying you should be trading thousands of shares of low float, under $10 BS crap stocks like this. You'll blow up your account because you likely would buy here. You get nervous, runs up a little, you add to it, you get stopped out. It starts to go up, hey, I'm going to buy the bounce. It's a bull flag move. Another 1,000 shares, you get stopped out. Okay, so you sit on the sidelines. It goes down here. It bounces. Oh, it's going to bounce. So you put on a 2,000 share trade and you get stopped out. And therefore, you blow up your trading account. Trading cheap stocks is the arena for morons and losers. You don't want to trade crap like that. You want to trade things that go a little something like this. See? Losing traders trade cheap under $10 stocks. Winning traders trade this, like an eye test. Loserville. Winner City. Bad trader. Stop it. Don't trade cheap stocks. It's like fool's gold. Oh yeah, I could buy 1,000 shares for only $3,000. It's much smarter to buy 100 shares of a $30 stock that's going to run a point or two and bank a profit with the same exact capital outlay. So stop the madness. There's got to be a better way. Don't trade cheap, pop and drop crap volatile stocks. You'll just end up broke and upset, and your wife will get mad at you. So don't do that. Volatility is a dual-edged sword. Volatility without context and stupid charts is a very foolish way to trade. I like charts that go a little something like this. This is what I call an acceleration ramp, where you got kind of there's no magic indicator that spots it for you other than your eyes, which are, your eyes and your brain are the best software. You got a steady uptrend followed by kind of a hockey stick angle breakout on higher volume. So you got volume and you've got new high volatility. And again, you run into resistance at whole numbers. So I like to, as a rule of thumb for swing trades, just simply add 50 cents to the nearest whole number high. Okay, I don't like spreadsheet-based type formulaic trading, but that's a simple rule of thumb that served me well for so many years. I'll share that with you. I mean, I published that in Stocks and Commodities for years too. But so the long trigger, if we add 50 cents to this whole number, would get you in at where? And not a trade recommendation, but for example, my Fidelity set for my interactive brokers, I'd do a buy stop 31.50, limit 32. So that way I'll get filled if it takes out 31.50 up to 32. I'm not going to buy it if it gaps up to 36 or 35 or 32.3 or something, but I will buy over 31.50. Anyway, a steady uptrend with increasing volatility on an instrument with enough range makes for a good trade setup. So those are the things that I want you to get at real clearly, is you got to trade instruments with tradable ranges and with sufficient volatility. Does this have enough range? Hain, this is a great chart. If you look at the 90-day daily candlestick chart, which is where it was headed, you see that the range is 4 points or more on a $40 stock, so it meets my 10% rule. Now, one of the patterns that I wanted to highlight is entries following wide candle days. There's nothing better to visually represent volatility than a nice, tall, healthy green candle. And one of the patterns that I've taught traders for years, which was ripped off by a competitor, but look for a wide range candle. I don't come up with stupid made-up names for my patterns. I'm plain spoken. Even though I'm a UCLA grad and a corporate guy, I still like to keep it simple. I call it what I see it. So a large green candle at the right side of, in this case, an ascending triangle, but at the right side of any kind of a pattern, a bullish cup, a congestion box. If you have a large green candle, add 50 cents to that, because odds are you're going to miss it on this day. Maybe you find it that night. Large green candles on high volume. And again, one of my articles in Stocks and Commodities looked at this 3 volume bar increase delta pattern. You have small, like baby bear, mama bear, papa bear. Schwang, increasing volume with increasing price action on a tall green candle is telling you that the institutional buyers are drying up the available share supply, like a sponge, soaking up available shares, leading to an increase in price. Okay, and we got a doji here and a couple of red candles on the pullback, so now it'd be fine to take profit if it drops under current support. But this tall green candle, and you'll see them all over the place. I mean, just eyeball. We had a big green candle in AME today, right? Not so big here. That was the biggest green candle there, and above that would have been fine. I'm just going at random through these charts. Large green candles are your friend. So look for breakouts above the high of large green candles and uptrends for stocks with volatility and range. Again, this one is good, SU, because 28 to 33, it's got a 5-point range. See, your odds as a trader are very determined, very much a function of the price action of the range of the chart. You know, if you're trying to trade cheap stocks, or if you're trying to trade low float stocks, or if you're trying to trade large caps that don't have a nice 10% or better range, your odds of making a profitable trade are not very good. One of the patterns that I'll tell you that served me well for many years, and again, this is that same exact pattern. You sell the decade, you sell the nines. And again, look in this month's issue of Stocks and Commodities for my article on that. But anyway, you sell anything with a 9 in it. It's a very valid approach. I just look at today's charts and it proves itself. Sell stuff with a 9 in it. You can always rebuy. You can always, mantra of a professional breakout trader, I'll tell you, is you can always rebuy new highs. So yeah, I'll get back in if it takes out 60.50, but I'd cash out today because it did hit the 9 price action, actually yesterday, because it hit the 59. That's fine. If you get in on a breakout or you wait till a cup pattern breakout, you go long, let it shake and bake a couple days, take a quick profit, and you're in good shape. And that's the type of pattern you want to look for. Volatility, gaps down, usually continue down. It's a big fallacy and a stupid boneheaded thing that a lot of I'm a professional trader. I trade gaps all the time. In the direction of the gap, if it's up to around 10%, this is actually maybe a 20% gap, so it may fade and bounce. But in general, I want to go short down here much more than go long in here, right? I learned that the hard way. It's not cheaper. It's cheap for a reason, you know. Maybe, and I don't care what the news was that brought this to its knees. Maybe it's an earnings miss. Maybe it's some bad news, you know, for some reason. I don't care. I just care how can I make money out of the chart. Likely to short a loss of the 15 whole number down at say 14.5 or so, and look for a cover target near 11 or 12 and make some money on the way down. If it does bounce, maybe I'll go long at 16.50. By the way, if you do play bounce trades, where is your exit target? And hint, it's not way up there. You're not going to get that. You're going to get at best half, 50%, so 18. So you play with it, maybe 16.50 to 18 would be the exit target. 50% of that range, a mean reversion pivot would be the best case on a bounce. But I still think this is a short chart, so I'd be more inclined to go heavier share size on a short than the share size I'd use on a bounce long. And volatility is a dual-edged sword, so there can be such a thing as either too much volatility or too little, or charts that are not worth trading because the underlying risk-reward isn't there. You know, I'm a big fan of charts with lots of heat. Here's one today, GIS. Did a mean reversion. Kind of little inverse head and shoulders are going on, but the point is we have a bullish cup. It broke out to new highs. That's all well and fine. It ran up. It pulled back to exactly or just about exactly 50% and then started to bounce. As a trader, your goal is always to get in on the first leg of the run. Don't try and forecast the reversal because often you'll just get stopped out and get in trouble. Expect a big move up, a reversion to the mean, the midpoint, and from a volatility standpoint, you're looking to play. This thing is on my radar now, so I'm looking to play this, you know, maybe tomorrow or the next day or next week. But it gets on my radar. Question from Fred was, how do I scan for these? I use eSignal. Control L is my friend, the leaderboard scan. I don't use any proprietary scanners. I'm an old school day trader. I sort my quote box by percent change and I go hunting in the most greens and the most reds, right? That's where I go hunting. And I look at percent gain and loss in the New York Stock Exchange and the NASDAQ, mostly the percent gainers, over 1 million close in my price range. So that's where you can start looking for potential candidates But there's, oftentimes you'll find leaderboard scans are fruitless. You see these choppy charts that, not worth a shot. So what I like to do is I keep a focused watch list of charts, at least in my own professional account, where I've got many more tickers to work with. So if I'm looking for an intraday breakout, for example, this was hot today, NOV. Again, I could care less what the company is or why it ran up. I just care, can I buy from someone at, say, I use that analogy too, wholesale retail. Can I buy at wholesale, say 33.10, and sell retail 33.5, 33.70? Right? I'm a breakout trader, so I like to buy strength. I don't buy pullbacks. We use previous day's lows as potential support, but I prefer cut patterns for breakouts, right? Previous day's high as an exit target for resistance chop zone. And you play a bullish cut breakout. If you play inside charts, those are more dangerous. This is inside the previous day's high-low range. From a volatility standpoint, you're looking for these charts that skyrocket on up to new highs to infinity and beyond, and you're looking to play those. Even if you, say, missed these today, you could still take the shot on a subsequent day. So you're looking for volatility across the board in charts that actually have relative strength that runs day after day, week after week, and has good relative strength, so that you're buying charts that have tight patterns with nice ranges. Okay. We got just a couple of minutes left. But does everyone start to see that 10% rule and also entries following wide range days? Visually, it's really important to be able to develop this. What you'll find, the more experience you have as a trader, you log a few thousand trades and a couple decades of experience, and you trade a few $1 million worth of stuff, you'll start to find that there's a very narrow path, kind of like Indiana Jones and the Temple of Doom or something. You're trying to walk through the path without getting arrows stuck in your side, and there's a very narrow path of stuff that actually works, and there's a whole lot of ways that trades can go sideways. And so I try to keep things simple and focused on good, clean price action breakouts with charts with multiple points of range on high volume and good sustainable trend strength. Just like people, you want to deal with people that have good, honest, ethics and good high integrity. They're focused, they work hard, they help people, that do the right things in the right way. You want consistency of chart patterns as well, just like with people. You don't want inconsistent. This would be like going out with a woman you met at a nightclub or something. Probably doesn't end so well, speaking from experience. What you want are, nice, honest charts that tend to run out and continue the run. Volatility begets or leads to additional volatility. And often, as pattern day traders, you'll find, or swing traders, you'll find that these patterns, or as Barry would say too, the cycles, will repeat themselves. So the open range ORB, the open range breakout length of run, will repeat itself. I'm one of the original .com day traders in the late 90s. I was widely copied and imitated. I came up with the original trading university, daytradinguniversity.com, before anyone else came up with university sites. And I originated a lot of the stuff that's now been copied by so many other people out there. I urge you to look for yourself to be an original and look for charts that have some kind of consistency built in. Because previous volatility, like people behavior, best predictor of future behavior is people's immediate past behavior. Best prediction of price action in charts, like our winners today and yesterday in lumber liquidators, LL, the chart, is the immediate past pattern. You can just kind of cut and paste this chart onto this chart. And a final thought for the day for swing trading is look for the length of runs. How far do things run before they don't? And for clues, look at the 90-day candlestick chart. I like to, as Barry, I use the 50, the 100, and the 200 simple moving average. I don't use the tighter EMA, though it's not a bad idea. It'll give you more momentum oscillation indicator. But look for how far, say, the trend runs up before it stalls and drops. Right? It ran up to about that tall before it dropped. Ran about the far here. So you can price project out both in the market. This is the S&P 90-day chart. As well as your individual stock charts or equity charts, how far are things likely to run before they stop? Do they find support at major moving averages or not? Stocks are always in a start-stop type of a progression. You're going to move up, kind of a cycle up, and then a sideways congestion. Then a new wave of buyers comes in. And then I told everybody in the world to sell the 39. I don't know if it was because of me. I published this in a Money Show. I did a breakout chart of the week video last week in which I said to sell on this day it was published to the world's traders. And sure enough, it dropped like a rock. So maybe people actually listened to me. That'd be gratifying. Anyway, you had a bearish engulfing here at a 9 price level at a 10. So that was a sell signal. That's why I told the world's traders to sell it on this day. And that was correct, right before the epic fall. Anyway, the market leaves clues, and your goal is to capitalize on them and make as much money as you can. So I hope that that helps give you some insights into my approach. It's all very simple and price action based. I don't try and use a lot of oscillators. Occasionally I use an average directional index. If you want to join me for, we got a big turnout tonight. We got 607. So epic turnout. Thanks to all of you for being here. And for more, I used to do these every week, but I got too busy. So now I do them every month. You can join me for free at trademastery.com/free. That'll get you to the GoToWebinar link for my first Saturday of each month, starting this Saturday. I've been doing these for over 5 years, but you can get in on those events, or you can go to trademastery.com, and the link is at the very top of the site. But I built a big loyal following of over 4,500 people as of today for these guys. And I used to do these every week, but now I just do them the first Saturday of each month. So still worth joining. Certainly like to see you there. You can learn from me for free on occasion. And I will see you guys in our next session. So thanks so much for being here. And I wanted to give a special shout out to my colleague, Dr. Barry Burns. He's a smart guy. He's worth learning from too, to learn the ins and outs of the thought process behind how to approach your volatility trading the right way, or a slightly more intelligent way than you may have seen elsewhere. So thanks, Barry, and thanks to all of you for joining us here tonight. I appreciate it. Thanks, everybody. Let's see, looking at the questions. Keith is asking, does my price with the 9 work on longer term charts? No, I use whole number support and resistance. I use 90-cent marks for day trading. So if I buy at, say, 32.20, my exit target's 32.80, 32.90. So I'll trade within the 1 point regions for day trades. For swing trades, I look for usually 50%, and that's another good quick question. I use 50% of the 15-day chart's high-low. So, for example, if we look at our interval chart, and I'm looking to buy something, let's see, that guy doesn't have quite enough volatility. Let's say this one. The 15-day high-low is, say, 26.5 to 31. So let's call it 4 points. I'm looking for a 2-point trade. I just round it. So it's around half of this trading range. It's around 2 points. So if I buy 31.50, I'll tighten in a trailing stop as it gets to 33.50. So I'll only expect 2 points. You don't expect to get the entire 15 days high-low range. You expect to get a kind of Fibonacci 50% level price extension on the upside. I don't use Fibonacci as a tool other than the 50%, and that's not unique to Fibonacci, but I do use that as a range. And the question about my measurement of volatility is the point range. So I'm looking at how far things tend to run and the length of the trend. How far does the trend go? I also look for things like, is the trend getting sharper? Are we getting to a nice 45-degree angle classic breakout above which we buy new highs? So they're slowly getting, it's like turning up the volume or turning up the heat on a stove. It's getting hotter and hotter and hotter. Then it starts to whistle as all these new institutional traders come in. They know something we don't know. We just want to capitalize on it. I want to make money. So if they're buying it, they know something I don't know. And I don't care to find out what they know that I don't know. I just care, can I make money? I'm all about the money. It's like Han Solo in Star Wars said, I expect to get paid. I'm not in it for the princess or the rebellion. I just want money. And if gold is what you want, then that's what you'll receive. And that's fine by me. That's what I do. I'm a trader. I'm a mechanic. I like to make as much money as I can out of these charts. So I'm just looking for the odds. Where's the most money going to be made in these charts? Oh, thanks. I appreciate that, Virginia, saying learned a lot. And yes, I will be sending out a recording. This will be on YouTube, so I will be sending the link, or more accurately, GoToWebinar will be sending out a follow-up email within 24 hours and that should have we'll have the YouTube link so you can follow up on that as well. So thanks so much for being here. I appreciate it. Oh, thanks. I am indeed in Colorado. I'm in Colorado Springs, right near the U.S. Air Force Academy. Good conservative town. All right, well, thanks. I guess that's about it. Thanks, folks. I appreciate it. Somebody said he went to my website and it says access is restricted. Yeah, just because of traffic, I don't let people from a lot of countries go to my Trade Mastery site. If you're from America or Canada or the UK or Japan or Singapore, you're fine. But a lot of the countries like China and Russia and the Middle East and all of Africa are blocked at a server level for my website because I get so much traffic at that site. I want it to move fast, so I have entire countries blacklisted from visiting my Trade Mastery site because they're from places that don't make for the best customers. But if you're from America or Canada or the UK or a lot of the major European countries or Germany or France or whatnot, you should be able to visit my Trade Mastery site just fine. So, and thanks. I will be sending out the YouTube link soon. You can remember my YouTube site. It'll be there at youtube.com/tradingtelevision. That is my YouTube channel. Bookmark that, and you will get to and subscribe if you want. And it'll be on that channel as soon as I get it posted, hopefully later tonight. So, anyways, thanks so much. Y'all have been amazing. I appreciate all of you being here. I certainly appreciate the opportunity to share the stage with Barry. He's a sharp guy too. Learn from him at www.topdogtrading.com. and myself at trademastery.com. Best wishes, and until next time, trade with passion, or at least a little bit of excitement. Trade with really tight stops. Play the field. Play multiple instruments, and try and go get them and make as much money as you can out there. Because the money's there to be made or lost, and it's up to you to make the difference. So I hope this has been informative. Take care, and I'll see you guys next time. Bye-bye.